Here's something most people don't realize. One of the most popular income funds on YouTube, a fund paying 12%, quietly cut its distribution back in 2022. Meanwhile, another fund on this list has been paying investors since 1929, 97 years, through the Great Depression, through 2008, through COVID. Same category, same promise of income, completely different results. So let me ask you this. When the next downturn hits, and at some point it will, are you the investor watching your balance drop or the one still collecting monthly checks? Today, I'm going to show you 10 funds that pay between 7 and 12%, funds that have kept paying through every major crash in modern history. But I'm not just handing you a list. I'm going to give you the 3 questions that separate real recession-proof income from a yield trap. And that third question, the one most investors never think to ask, that's the one that would have warned you about the 12% fund before it cut. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. All right, the 3 questions. Question 1. Did this fund actually pay through every recession? Not just last year, every recession. Question 2. Is the income real? Is the fund earning enough to cover what it pays you, or is part of your check actually your own money coming back to you? And question 3, is the total return positive? Because if a fund pays you 10%, but the value of your shares drops 8%, you didn't really make 10, you made 2. Big difference. Smart investors know the yield. The smartest ones check all 3. Now, before we get into the funds, I'm curious, are you building this income to eventually replace your paycheck, or are you investing purely for long-term growth? Think about that, because the answer changes which tier matters most to you. Let me show you what the 3-question test looks like when you actually run it. The lights stay on. We're starting with the safest category here, utilities. Think about it this way. When the economy slows down, people stop buying new cars, they eat out less, they cancel trips, but nobody, and I mean nobody, stops paying the electric bill. The lights stay on. And with data centers for artificial intelligence popping up everywhere right now, electricity demand is growing faster than it has in decades. That's why utility funds are the foundation. First up, DNP, the DNP Select Income Fund. Current yield around 7.2%. It pays 6.5 cents per share every single month, and it has done that since 1997, nearly 30 years with no cuts. Not in 2008, not during COVID, not during the 2022 bear market, just a steady check every month like clockwork. Now here's the thing, DNP trades at about a 10% premium to its net asset value right now. That means for every dollar of assets inside the fund, you're paying about $1.10 to get in today. Worth knowing. 3-question test, passes 1 and 2. Question 3, that premium is a yellow flag. Next, UTF, the Cohen & Steers Infrastructure Fund, yield around 6.8%. This one is broader. Utilities, pipelines, toll roads, communication towers, global infrastructure, and here's what caught my attention. UTF trades at about an 8% discount to its net asset value. That means for every dollar of assets inside the fund, you're paying around 92 cents, built-in margin of safety. And they just raised the distribution in 2026 from 15.5 cents to 16.5 cents a month. That's a raise, not a cut. Passes all 3. Now, UTG, the Reeves Utility Income Fund, it has raised its distribution 14 times since 2004 and has never once cut. Sounds perfect, right? But look, here's the number most investors miss. Over half of UTG's recent distributions came from return of capital. That means part of your check is technically your own money coming back to you. Now, a lot of that is actually long-term capital gains being reclassified for tax purposes, so it's not as scary as it sounds, but it's still something a smart investor watches. UTG passes question 1, mostly passes question 2. Question 3, keep an eye on it. 3 utility funds, 2 clean passes, 1 with a flag. But there's another category that's even more recession-resistant, and it comes with a tax trap that could cost you real money if you hold it in the wrong account.
The pipelines paychecks. Pipelines, specifically Master Limited Partnerships or MLPs. Here's why pipelines work in a downturn. They don't make money on the price of oil. They make money on volume, how much oil and gas flows through the pipes. Think of it like a toll road. The price of a car doesn't matter. What matters is how many cars drive through. That's the pipeline business. First, EPD, Enterprise Products Partners, the gold standard. EPD just declared its latest increase to 56 cents per unit quarterly, 28 consecutive years of distribution growth, the longest streak of any midstream company in the United States. Now, the yield is around 5.8 to 6%, technically below the 7% floor in the title. I want to be upfront about that. But here's why EPD belongs on this list. With 28 straight years of raises, the yield on your original investment keeps climbing every single year, and the coverage ratio, the cash the company earns versus what it pays out, is 1.8 times. For every dollar they sent you, they earn $1.80. That's one of the strongest coverage ratios in the entire income space. 3-question test passes all 3 easily. Next, MPLX, yield around 7.5 to 8%, 0 cuts in its history, and management committed to a 12.5% distribution increase for both 2026 and 2027. A 7+% yield that's actively growing by double digits. That's rare. Now, here's the tax trap, and this is critical, especially if you're younger and building inside an IRA or Roth. Both EPD and MPLX send you a K-1 tax form instead of the normal 1099. K-1s are more complicated and they usually arrive late, but the real problem is this. If you hold an MLP inside an IRA, it can trigger something called Unrelated Business Taxable Income, or UBTI. If your UBTI goes above $1,000, your IRA itself has to file a tax return and pay taxes at trust rates, and trust rates hit the top bracket way faster than individual rates. We're talking the 37% bracket kicking in around $15,000 of income inside the trust, way lower than you'd expect. Simple fix: hold EPD and MPLX in a taxable brokerage account, not an IRA, not a Roth, taxable. And actually, in a taxable account, the MLP structure works in your favor. Most of the distribution is tax-deferred return of capital. You don't owe taxes until you sell. That's a feature, not a bug. Quick question before we move on. Do you own any MLPs right now? And if you do, are they in a taxable account or an IRA? Drop your answer in the comments. I read every single one. The yield trap test. All right, the utility and pipeline picks, those are the foundation. Strong payouts, real businesses, recession tested. But here's where it gets interesting and honestly a little risky: the double-digit yield tier. Funds paying 10, 11, even 20%. The question is that income real? Let's start with the fund that surprised me, PTY, the PIMCO Corporate and Income Opportunity Fund. Current yield about 12%. You've probably seen this fund recommended all over YouTube. Here's what most of those videos don't tell you. PIMCO cut PTY's monthly distribution in late 2022. The total payout for 2023 came in roughly 9.5% lower than 2022. 12% is still 12%, but the claim that it's never been cut, that's not true. It did cut. Now, here's the update that actually matters. PTY used to trade at a 20 to 22% premium to its net asset value, meaning you were paying $1.22 for every dollar of assets inside. Today, though, that premium has down to about 4%. If you bought at that 22% premium, you lost ground even while collecting checks. But if you're looking at it fresh right now, the entry price is the best it's been in years. PCN, PIMCO's sister fund, about 11.6% yield. Same risk profile. Its premium has also compressed, down from around 16% to about 6%. Better entry than a year ago. Same leverage and credit risk underneath. Now, GOF, Guggenheim Strategic Opportunities, and this is the single biggest change since the last time I covered this topic. GOF's yield is around 20%. It has never cut since 2007, but GOF used to trade at a massive premium. We're talking 20 to 36% above its actual asset value. Today, though, that premium has collapsed to about 2.6%, almost flat. The toll booth just got cheaper. But here's the thing. Even at a fair price, a big chunk of GOF's payout comes from return of capital. The fund's net investment income covers only about a third of what it distributes. The rest, your own money recycled back to you. Remember question 2? Is the income real? With GOF, most of it isn't. And then PDI, PIMCO Dynamic Income, highest yield on this entire list, around 16%. Now, the last time I covered this fund, I listed its leverage at 44%. I want to correct that. The actual effective leverage is about 32%. Still high, but not as extreme as I originally stated. Getting the numbers right matters. Its premium has also dropped from around 13% to about 4%. Here's the myth. A double-digit yield means a double-digit income. Here's the truth. If a fund's total return is lower than its distribution rate, part of that monthly check is your own money coming back to you. That's not income. That's a slow goodbye to your principal.
Does that mean avoid all 4? No. PTY and PCN can work. Sized correctly, eyes wide open about the cut history and the leverage. GOF and PDI are satellite positions, small allocations, never the foundation. The 97-year survivor. Now, there's a 10th fund I haven't shown you yet, and honestly, it might be the most important one on this entire list. ADX, the Adams Diversified Equity Fund. This fund has paid distributions to shareholders since 1929, 97 years, through the Depression, World War II, the dot-com bust, the 2008 crash, COVID, all of it. ADX isn't a bond fund. It's a diversified equity fund holding blue-chip stocks. Its top holdings right now include NVIDIA, Apple, Microsoft, Alphabet, and Amazon. It targets an 8% annual payout. Current yield around 7 to 8%. Trades at a small discount to NAV. And here's the number. The 5-year total return is roughly 108%. That's not a typo. No flashy 12% yield, no leverage, no premium trap. Just 9 decades of showing up and paying. Now, I know some of you are thinking about the newer covered call ETFs, JEPQ, JEPI, QQQI, SVOL. They're everywhere on YouTube right now. Some pay double-digit yields, but here's the problem. Not a single one has survived a real recession. They were all launched after 2020. Run them through the 3-question test, and they all fail question 1 on day 1. They might be fine down the road, but they're not survivors. Not yet. Your 3-tier playbook. Let me put all 10 together. Think in 3 tiers. Your core, 50 to 60%. That's DNP, UTF, UTG, EPD, and MPLX. Essential service businesses, lowest drama, the checks that come no matter what. Your boost, 25 to 35%, PTY and PCN, double-digit yield, but you know the risks, premiums, leverage, and a real possibility of another cut. Size them modestly. Your satellite, 10 to 15%, GOF and PDI. Highest yield, smallest allocation. They amplify income, but they never become the foundation. ADX sits across all 3 as your equity growth engine. Now, where you hold these matters just as much as which ones you buy. Put the MLPs, EPD and MPLX in a taxable brokerage account, never in an IRA. Put the PIMCO and Guggenheim credit funds in a Roth or traditional IRA, where their ordinary income is tax-sheltered. And the utility and equity funds, those are flexible. Either account works. And one more thing. Right now, with treasuries paying around 4.5% risk-free and high-yield savings accounts near 4%, every one of these funds needs to earn its spot. A 12% yield that erodes your principal isn't beating a 4.5% treasury that keeps it intact. That's why the 3-question test matters more today than it ever has. Here's what I want you to remember. The yield on the label is not the income you keep. The income you keep is what survives the crash. If someone you know is chasing a double-digit yield without checking total return, share this video with them right now. It could save them real money. Now tell me in the comments, which tier are you most drawn to? The Essential Service Core, the double-digit boost, or the high-yield satellite? Drop it below. I want to know where your head's at.